Welcome back to another episode of In Focus with Haversine Funding, the podcast where we discuss trends, insights, and strategies that drive success within specialty finance. I'm your host, Nolan Reichert. Today, I'm joined by my co-host, Jeff Whaley.
Thanks for having me. It's always a pleasure.
Thanks for coming back on. I know I always say that every time. I don't know how I keep convincing you to join me. But today, I have a really interesting topic that we wanted to talk about. We wanted to discuss the economic outlook of the second half of 2025. There's been a lot of discussions around inflation. Tariffs is a big one, shifting consumer demands, as well as questions about monetary policy. So I figured we could kind of sit down and discuss how that's going to shape the outlook for the rest of 2025 for us specialty lenders, as well as, us as consumers. And joining us to help break all of it down is none other than Lauren Saidel-Baker from ITR Economics, that is now a part of Crow LLP. Lauren goes around the country with speaking engagements and talks to companies how they can take these trends in the economy and turn them into real valuable insights and strategies to help shape their next steps within the space. Lauren, thank you so much for joining us.
Thanks. It's great to be here.
Absolutely. So to kind of start us off with a very wide net question, I'm really curious how you think, based off how the beginning of 2025 has gone and all the questions that we're seeing, do you see any trends that we should be on the lookout for the remaining of 2025?
Oh, goodness. So many trends. There's a lot going on kind of beneath the surface with this economy. You mentioned tariffs. I think that is the one that's causing the most uncertainty. But as I do this deeper analysis, right, as we're looking at those fundamental leading indicators, we are finding that tariffs and headlines, right, whether it's tariffs or just whatever pronouncement comes from the Trump administration, all of those policies, they're impactful. They'll impact specific sectors. They'll impact maybe something like inflation, but they're not enough to overwhelm that fundamental cycle. So we still do see the fundamentals holding up relatively well. If you just follow the headlines, you might miss that, though. So there are a lot of very doom and gloom headlines. I get it. That's what sells a newspaper. But things like first quarter GDP, it came in lower than fourth quarter of 24. And so everyone said, well, we're halfway to a recession, right? This is the contraction. This is the start of it. Really, all we saw as economists is that imports were pulled forward. They were front-running tariffs, trying to get goods into the country before tariffs went into place. And so they're front-loading this, what would have happened in the second quarter into the first quarter. And the way GDP is calculated, of course, imports are subtracted against the total. So it's just that timing shift that's enough to give us a headline contraction, but really not the bottom falling out from under the economy.
Mm-hmm. Wow. Right. Yeah, that's interesting.
Yeah, and one of the big drivers in these shifts is the election. Has there been any surprises since the election that kind of took you and the team kind of by surprise that you guys had to adjust some of your models or projections for?
So I'll start by saying ITR Economics, we are apolitical, we are nonpartisan. So anything I say about politics, this is not meant to be a moral judgment. Nothing is good or bad, even tariffs, right? We're free trade economists, so we tend to not love tariffs, but we readily admit tariffs are good for some individuals and companies and bad for others. All it does is skew incentives. It creates different winners and different losers. Now, it depends what side of the table you're sitting on, if you like tariffs or if you don't. So I think from our point of view, we did not change our broad macro outlook after the election, certainly, but even now that we've gotten the actual policies starting to come into effect, even something like tariffs. We'll get a tariff put in place, then we get a rollback, right? We get a 90-day pause. A court blocks it. Another court blocks that court block. There's just so much uncertainty. We don't want to be changing our forecast every time the news shifts, every which way the wind blows. And so that's why we're much more focused on that long-term business cycle, right? On those fundamentals that really are still coming through. Mm-hmm. Now, from the business community specifically, we did see a little bit of not whiplash, but a change in attitude. A lot of business sentiment, right? CEO sentiment really surged immediately after the election because they saw the Trump win as tax cuts, as less regulation. What happened on day one when he came in, he didn't focus on those items. His priorities were deportations and tariffs, which are a bit less business friendly. So that's why I think the uncertainty is as elevated as it is. And we saw CEO sentiment surge in late 2024 and then absolutely plummet early this year. That doesn't necessarily mean those underlying business decisions are different, but the feeling, right? The sentiment amongst businesses, it's gotten kind of backed off from those highs that frenzied, right, excitement of late last year and into more of a wait and see environment.
I mean, we've talked a lot, initially already about, domestic politics and the intersection of economics and domestic politics. But is there anything geopolitically external to the United States that's interesting to y'all, interesting to you and your team when you're modeling the macroeconomics? Anything that, especially supply chain related, that you think bears watching over the next quarter or two?
So the big macro trend, and this has existed pre-Trump, this has been a multi-year, if not decade cycle at this point, is re-onshoring. It's that nationalization trend, not just here in the US. We see nationalism kind of popping up worldwide, but specifically the US is a really good place to do business. We've narrowed the cost advantage that Asia used to have over domestic US production, and we have really a huge domestic demand source, right? A huge consumer class. So we've seen over years and years that investment, foreign direct investment, really surging into the United States. A lot more production coming on here. Not in everything. I don't think we'll ever be, sewing apparel in the U.S. It's just a different type of supply chain that exists elsewhere. Or making iPhones is a good example that people like to use. But we are bringing on a lot of high tech production, the semiconductor production that's really surging, data centers popping up across the US. So I see tariffs as not the driving force, right? The goal of tariffs is to protect that domestic production, even to bring more of it back to US shores. At the end of the day, I don't think with such high uncertainty, with some challenges that we do still have with, say, labor availability, that's not going to be the thing that causes businesses to come back in the first place. Really, they're looking at these broader factors, the cost difference, again, that consumer base, things like plentiful energy resources. We have relatively cheaper electricity than in Europe or in Asia. So there are good fundamental reasons to do business in the United States. And I kind of want to decouple that from the tariff discussion, right? Maybe that's a little bonus. Tariffs are the cherry on top if your foreign competition has a higher tax to bring their goods into the country. But at the end of the day, I see that flow continuing for reasons that are not tariff related, right? If you had an investment somewhere else, you're not abandoning that investment, abandoning that facility to move it to the United States. It would probably take you multiple years even to make that move if you wanted to. And with a presidential term being only 4 years, we don't know what tariffs look like after this administration. I don't think that's causing the change. So the good news is if tariffs went away completely, I also don't think that would cause a reversal.
No, and I think your point about the narrowing, especially of labor costs between the United States and Asia, is a really, really good one. That I think we may want to touch on a little bit later in the interview. But while we're on the subject of tariffs, this is more of a theoretical question, and this is something I've been bouncing around in my head, especially now that tariffs have really come to the forefront of everyone's mind over the last couple of months. When you think about tariffs, I've seen so many different points of people approach it, how they think about tariffs on a macroeconomic basis in the news lately. I see a lot of people obviously talk about tariffs. Well, they're a tax on goods and services that are being imported, or goods are being imported in the United States. So that would lead theoretically to higher costs. But by the same token, tariffs are a tax, and tax increases are generally deflationary, that they slow down economic activity. They're a disincentive for economic activity or consumption. When you think, and I think this is important for the way we all think about economics. When you look at tariffs, do you view them as a price increasing function, or do you view them as deflationary? Because I'm really struggling to get a feel in my mind about whether I should view them as inflationary or deflationary.
Yes, we view tariffs as inflationary. They will raise that cost of foreign competition coming into the United States. We don't have a huge amount of precedent, but we do have a couple previous rounds, both from the first Trump administration as well as the Biden administration. We've seen tariffs under red and blue presidents. Really, the 2018 round, that's the longest time history we have up till this point. What happened in that round is domestic producers, they didn't just take kind of the market share grab when the foreign competitor good became more expensive. What they did is they actually took price. Now, I can get into the other drivers behind this, but for a number of reasons, we see margin squeeze being a pressure that businesses will face, at least for the near to medium term. So these domestic producers, right, they're feeling those higher labor costs with a tight labor market. They're feeling increasing energy costs, commodity prices probably starting to tick up at this point. So what is more likely than them just taking market share and holding pricing steady is they will also pass through prices either to expand their margin, or what is more likely is that same domestic producer, they don't source everything that they need, those raw materials, those intermediate goods, they don't source them all here. They need some amount of supply chain, right? Some imports coming in, and they're now facing higher prices if we have, say, that universal 10% tariff or some of these more broad-based taxes on imports. So what tariffs have done in the past, again, the recent rounds, the recent precedent, is they increased cost across the board. Both for foreign and domestic goods. But for those domestic producers, they led to a more complicated supply chain. It really took out some efficiencies, some of the, just adding complexity to the supply chain. So anytime we see that, just different choices being made and where do I source from? I'm not looking for the lowest cost producer anymore. I have these other kind of levels of complexity being roped in. That just decreases the efficiency.
Mm-hmm. And you kind of touched on my next question a little bit, but we have seen inflation cool down a little bit. Is there anything else that you would think that is driving the disconnect between the data, what the data is showing versus business sentiment?
So with inflation particularly, we do see inflation coming back for reasons far beyond tariffs. There are fundamental drivers. We could look at anything from the money supply, the velocity of money, just look at some liquidity indicators out there. Those have been moving north for a couple of years now. So they are showing that by, I'll say, mid to late this year, we'll start to see that inflation really ramping again. I don't think we're going to get comfortably in that 2% range that the Federal Reserve wants us for very long, at least.
So I was watching one of the Fed watches that you have out on YouTube. By the way, for any of our viewers, if you want to go out, look for ITR Economics on YouTube. They've got a lot of great material out there. But in a recent Fed watch you did, you mentioned expectations of 2 rate cuts this year, and I've heard that obviously as well. But when I hear that, and then what we see, what Nolan and I see, and from talking to clients and talking to people in the space, is that inflationary pushes are still there. Doesn't it feel like does it seem realistic that we're actually going to get 2 rate cuts in the remainder of the year? Because there's still, like you said, even tariffs or no tariffs, there's still a lot of the same, and even with tariffs, I think it exacerbates it. There's still a lot of those same driving forces that are pushing inflation up. Do you still feel like even that expectation of 2 rate cuts is realistic for the market to be expecting right now?
I think the market's a little bit maybe reaching for that. I think it's not our base case. Certainly, we at ITR Economics have been saying for over a year, I'll have to go back and check my notes for when we started putting this out, but that rates would be their lowest right about now, the first half of this year. Again, with that mounting inflation that has been our base case expectation for quite some time now, tariffs are just the cherry on top. Tariffs are an upside risk to even more inflation happening. Now, you can get to an academic argument between, do we look through those tariffs as a one-time price adjustment, maybe don't move Fed policy based on them. But at the end of the day, there is fundamental inflation in our system. It is coming back. The Fed got behind the eight ball on inflation once, right? We've seen that recent experience. That was not a comfortable place to be. They do not want that to reoccur. And when you couple that with a still pretty tight labor market, yes, the labor market is loosening marginally, but this is, by broad historical standards, a very, very tight position. We have right now just about one unemployed worker for each available job opening. At the tightest point, we had two open positions for every one unemployed worker. So yes, we have seen loosening in that direction, but historically, there are usually multiple job seekers per job opening. So we are not back to the type of labor market that the Fed should really need to support to keep that growth going. I have trouble seeing them do too many cuts. Again, maybe we get another 25 basis points. I won't say never, but 50, that's where you're starting to kind of reach, I think. So I think the market here, it's maybe a little wishful thinking. I heard one expectation, I think it was for 7 rate cuts next year, and I just don't understand how you get to that conclusion.
It is interesting because if you look at like the SOFR yield curve, I mean, you can see those expectations out there right now. And if you even some of the surveys that they do of Fed watchers, that I mean, it really does feel like, I mean, let me know if you disagree, that the Fed's they're on treacherous ground when it comes to data and think where direction things are moving the market. It really does feel like they're kind of in a no-win situation.
They are walking a tightrope right now. I don't see how, yes, it's a no-win situation for them. They could do worse decisions, right? They could make it worse in a number of different ways, but that best case outcome, I don't envy them their job right now.
Yeah. You had touched on the labor market. That was something that we wanted to dive into as well. We're seeing, incredible constraints in that space. You did mention that it is loosening up a little bit. Do you think that's going to continue to loosen up through the remaining of 2025? What's kind of your outlook with the labor shortage?
So the labor market, it's very specific to skill sets, right? Even with that general loosening, there are still specific jobs and specific, kind of skilled work that we really cannot find the workers for. Every time I talk to one of my consulting clients in the manufacturing space, they say, hey, if you know anyone who's a CNC machine operator, I mean, finding them is like finding gold. We just can't possibly find. So they're actually shutting down these very, very expensive machines, not getting the runtime they need just because they can't find the skilled operators. So the labor market, while we hear, again, the headlines, tech sector layoffs or federal government layoffs, there's a little mismatch in existing skill sets. We might need to see some reskilling before we kind of smooth this out. But longer term, again, our outlook is for growth really to be picking up steam this year. So that will necessarily cause more openings, right? Draw more labor in. I do see that kind of tightening, picking back up. And on the other hand, we don't have a new glut of workers coming onto the scene. If you look at our prime age labor force, our participation rates are at something like 20-year highs. So there are fewer folks kind of sitting on the sidelines who could be pulled back into work. We just don't have a large generation aging in. If you look at Gen Z, those folks who are now kind of leaving school, getting their first jobs, they're a much smaller generation even than my millennial generation. They are certainly not sufficient to replace all of the retiring baby boomers. So at some point, it's a numbers game. We could look to immigration to fill some of that gap. Under this administration, I think we're moving in the opposite direction, taking in fewer immigrants rather than more. Legal immigration, it's just over 1 million legal immigrants per year. Compare that to about 6.5, 7 million job openings today. That isn't filling the gap. If anything, these mass deportations or even just threat of mass deportations, right? If ICE is going to be on the job site, I'm not coming to work tomorrow. To me, that's a real risk to the agriculture sector and the construction sector more than anything else. But others, specific pockets, will also feel that pinch.
And knowing all of this, and when you're talking to your clients, I guess, I mean, what's your advice for them? What's your advice that I mean, obviously for the people watching this, how should they be thinking about when they're looking 24 months down the road? What should they be doing to manage their labor force? Is it what you're talking about, really investing in on the job training? I mean, how would you suggest they think about the way they're planning for the next 12, 24 months?
Well, first of all, if you need more workers, now is absolutely the time to hire them. I would argue maybe even 6 months ago was the time. So look for that skilled talent. Maybe there is a little bit more looseness in the labor market now. You can scoop up those great skilled people if you can find them. Again, I think it gets harder, not easier going forward. So I wouldn't be waiting. But beyond that, you're going to need to budget for higher cost because as there are fewer qualified employees out there and more employers want them, that puts upside pressure on wages. We've seen that for several years now, but don't think we're out of the woods, that this is when we can stop giving those higher cost of living adjustments. I would really be budgeting, especially for your A-level players. You really want to retain them. It's cheaper to retain a quality, skilled, trained up employee than it is to go find a new one, hire them at probably a higher salary, again, train them, all of those resources that go into getting them tooled up. But beyond that, if you can invest in efficiencies, maybe there's some machinery, some automation. AI has a lot of great potential here. Do more with fewer or the same number of individuals. That is going to be a long-term cost savings. And I hate to be an optimist because I am an economist at the end of the day, so that is not in my job description, but take this for what it's worth. Higher wages, more people being employed, that's more people making more money. That means our consumer base is on solid footing. That means
Right.
we're not like in a 2006 style, over levered, overstretched consumer that doesn't have that basis behind it. The bottom is not falling out from our economy. As long as the consumer is doing better, which today they are, those wage gains are outpacing inflation, that means we're in a better spending position. And 2/3 of GDP comes down to consumer spending. So I really see this tight labor market supporting the consumer as the engine that is
Hmm.
turning our whole economy today.
I mean, it's reminiscent of Ford way back in the early 20th century saying that he wanted his workers to have enough money to afford to buy his cars. So
Exactly.
in the long run, that obviously is a very good thing.
Yeah. Um, so we work with we're a lender and we work with a number of lenders as well that lend to very different industries from manufacturing to, like you'd mentioned,
Mhm.
construction, business services, SaaS, you name it. So from a lender's perspective, knowing what you know with the labor market, would that change the way that you were underwriting or looking at it, your credit risk?
So any consumer credit risk I see as being pretty steady right now, right? We have that stability in our consumers' ability to go out and service their debt. I know there's a lot of very scary headlines about the amount of debt that's being taken on, but keep in mind, we have a growing population, so that's more debt accounts to have, and we have inflation. So maybe back in the day, my debt was a nickel in a can of soda pop, but today, right, it's going to be a higher base. So anything consumer based, we're still in good shape. Now, I say that with a slight caveat that things like housing, with these higher mortgage rates, with just home prices doing what they're doing, mortgage payments on average are much higher today than they were even a couple of years ago. So affordability is pinching some of those would-be first-time home buyers. They're stretching a little more, right, to maybe make that first home purchase. I don't see that as a problem so much for the lending side of the equation as maybe the construction side, where we're just disincentivizing new home construction if we don't have that same level of sales and activity pass through. We do still need more housing units, right? We're undersupplied. We have very low inventories,
Out.
but at the end of the day, that's kind of being a wet blanket on construction growth.
Hmm.
Now, any lending that's going not into housing, but into the non-res sector of construction, that's where I think we're on shakier footing. The non-res cycle does tend to lag behind housing by about 2 years. So they're currently seeing much slower growth. I think some sectors will even see a mild pullback this year and next. This will not be severe. So again, I'm not saying run for the exits, but just maybe watch some of your multiples, be a little bit more conservative in the short term.
Hmm.
Beyond that, though, I mean, there's a lot of good reasons for growth here in the United States.
Yeah.
No, and actually, it's fantastic because you're leading in kind of the next question. I mean, you're talking about the real estate, residential and non-res sectors. What other parts of the economy or industries do you feel most bullish on? I mean, obviously, I think that with Doge, there's been some movement in government spending, and I imagine that affects the larger economy overall. But what are some of the
Mhm.
industries that you feel best about going to the next 12, 24 months?
Right now, it is the consumer. So anything that has
Oh.
the consumer as your end user or as your kind of closer proximity end user, those are going to outperform in terms of growth. So the service sector is really outperforming the goods sector right now. That's not to say that manufacturing isn't picking up steam. We are seeing uptick in those leading indicators. The industrial economy, it was basically flat, just dead flat last year. It was
Right.
very, again, not outright collapse. This was not the bottom falling out, but just nothing to write home about. We're starting to see a little bit better news for 2025, probably picking up steam late this year, moving into 2026. But again, service sector is absolutely going to outperform. And there are key kind of subsectors. So within the general industrial space, we need more energy. Anything energy generation, oil and gas space is going to perform relatively well just because we have that increased demand. Other broader industrial sectors, right? We see chemical being a good place to be, not too bad. Again, starting to see that pick up, but within that sector, pharmaceutical is really performing well compared to some of those more industrial based chemicals. So it's a matter of where you're looking. There's a lot moving kind of beneath the surface. We put out a lot of sector specific indicators. You can see some of those on our website and our blog post. But if you could only pick high level, I really like consumer, I really like service sector, a little bit more than those kind of traditional legacy industries.
Yeah, that seems to continue a trend, especially the service. I mean, obviously, I think that's probably one of the biggest stories over the
Yeah.
past couple of decades is the growth of the
Yeah.
service sector economy in the United States. Okay, well, those are the pauses. What do you think? What do you see as laggards? Where do we need to be a little bit cautious about, or just keep an eye on?
Mhm.
I'm very cautious in auto. That's something that just has been struggling. Again, higher loan rates. That's going to be challenging for affordability. Tariffs really can kneecap this industry. So I see especially trade with, say, Mexico, where so much cross-border trade. You get an intermediate good, you start the vehicle's life in this country, move it across the border, do something to it, send it back, do something else. There's just so much complexity to that sector. That is going to really be a challenge. Again, non-res construction, anything that feeds into that. So some of our machinery categories might take a little bit longer to come back to life. Anything that we're really needing that interest rate base stimulus. So anything that, right, I'm going to take out a loan to invest in. We're seeing, again, that maybe aspirational move from the market that, oh, I'd love to borrow at slightly lower rates, or maybe I wait till rates went back down to where they were in 2019. We're not getting rates that low again. So I think it's
Those
taking a
days are
little
gone.
bit more time. Businesses just have to accept it, right? They have to change the mindset. This is the new norm for interest rates, and this is what the market will support. Don't miss the ball because you're waiting for rates to go where they aren't going.
Mhm.
Let me ask you about one sector in particular that I think is of
Mhm.
interest to a lot of our viewers, because mainly because it touches a lot of everything. And I hate to put you on the spot, so if this is not a sector you'll
Sure.
have an opinion about, but what about transportation, about goods
Right,
and
yeah.
transit? What do you feel? Where do you feel that sector is headed?
I see good news ahead for transportation equipment. Again, non-passenger autos, right? But more rail and truck, especially trucking here in the United States. I see that investment starting to come back, and we really just need that additional transportation capacity, given everything I've said about re-onshoring, about the supply chain normalizing, but finding new nodes with this new normal, right? This change in just where we produce the goods and get them to our ultimate consumer. So it's probably not my highest growth industry that I have going forward, but a pretty good one today.
It's been an industry it's been in the
How many?
doldrums really for 2 years, I would
Yeah,
say.
yeah. It's
So those guys, any potential for positive news
I
is
know.
very, very welcome.
They've been
Nolan knows the industry much better than
they've
I
been
do, but
trying to ride the optimism. What feels like 2 years,
yes,
and
they
it's
have.
it's just a couple months longer. Just a couple months longer. But no,
Yeah.
I saw some reports as well. That private equity is starting to flock a little bit back to that space
Right.
as well. So hopefully we do see that turnaround. Those trends continue to pick up. Now, I know we've talked about a number of topics that are driving these economic shifts. So from, our audience are lenders. Like I had mentioned, we're lenders as well. So what strategic advice would you give lenders in this shifty economic environment?
I would say know what matters, because right now it's not the headlines, it's not the news flashes or the noise is how I think about it. Look at the fundamentals. You sometimes have to go into the government websites and get that hard data, but it really is showing a compelling story, which is a general pickup in growth. Again, not growth bouncing back to this heyday of 2021 and 2, where we were just bouncing off of that COVID era low, but we're seeing more sustainable growth this time around. So I would say this is the time to be, if you haven't been investing for it already, this is the time to really be ready before that demand hits. Now, I will drop a bombshell on you. We at ITR, we are saying the next 4 to 5 years are looking pretty good. Again, steady growth, consistent growth. But leading up to the end of the decade, 2029, 2030, we see a depression coming. And I want to be very clear. I am saying depression with a D, not recession with an R. This is no 2008. This is deeper. This is longer. Just so many imbalances within our government spending and our government debt, coupled with our demographic picture. I think the end of this decade looks really bad really quickly. So definitely make hay while the sun shines, enjoy this next period of growth, and use that maybe to pivot a little bit to get into some more resilient industries where we won't see as much downside as, say, the more discretionary categories that do tend to fall farther and harder. And don't be over levered heading into the end of the decade. So as much as I'm encouraging investment now where you will have that demand, right, you need to be able to meet it, I would not be over levered or taking on a ton of new debt a year, 2 years from now. I think that's just kind of buying into the peak, and we don't want to see that happen. So a little bit more conservatism headed into the end of the decade is going to be really helpful. And then the real pivot is going to be protecting yourself on the downside and just being ready to buy once we do hit that low. That is going to be the greatest wealth generating event that any of us will ever see. So anything you can do now to position yourself to withstand the downside and then be ready to pounce at the low. That's my ultimate long-term advice.
Mm-hmm.
One quick question, obviously a lot of us, I'm an accountant by trade, but a lot of us in the space, we like to play immature economist, which I'm sure drives you absolutely crazy sometimes when you're at parties.
I love it. Yes.
But you meant you kind of touched on it in this question. If we're trying, I think everyone gets very either seduced or scared to death by the top line headline numbers. What are the types of measures that we should be looking at in the real economy, and that any of us who are obviously armchair economists, what should we be looking for? What should we be looking at?
Well, it depends what sector you're in. So again, if you're more consumer focused, we look at headline GDP. Even that, as I mentioned earlier, had some distortion due to the timing of imports this cycle. So maybe you want to look at something like retail sales, even a deflated measure of retail sales to get that volume impact, not just the price plus volume, kind of inflation fueled retail sales number. But if you're in more of the manufacturing space, I'm looking at the industrial production index. I'm looking at things like the PMI as a leading indicator for where we go from here. We tend to see everything doesn't move in exactly perfect timing. So we can get that peak around the corner if we use the right leading indicators. Capacity utilization is a really good one. How much of our existing capacity is in use today? And what does that mean? Will we have capacity constraints and need to see more investment? At the end of the day, it's about knowing what correlates best to your industry, your data. That's something we just live and breathe here at ITR.
Yeah, that's great. A lot of great information here. I think our viewers and listeners are really gonna love this one. If you had to boil down everything that we had talked about into some key takeaways for business leaders or even as consumers, what would some of those key points be?
I would say no recession this year. Our consumer is too strong. They are the backbone of our economy right now, and they are keeping that engine turning. So don't be doom and gloom. Don't just pivot on the headlines every which way the wind is blowing out of Washington. There is reason for optimism in the next couple of years, but by the end of the decade, have a plan in place. Don't execute today. It's too soon. You'll miss that upside, but have a plan for how to batten down the hatches, protect yourself on the way down, and then buy at that next low.
Right.
I love that. And where can our viewers and listeners hear or learn more from you and your team at ITR Economics?
Yes, the best place is our website, itreconomics.com. From there, you can link to a lot of free videos on how we do, what leading indicators we look at, how we even calculate a rate of change to start that analysis. We have free blog posts if you're interested in just keeping up with our thinking. We have a lot of videos, so check out our YouTube channel. FedWatch is one of my favorites. It just talks about what is the Fed thinking about? What happened this week? It comes out every Friday with just what does this week mean for policy going forward. We also have one called Trends Talk about all kinds of different trends, whatever catches our fancy week to week. So much information there. You can catch us on all of the usual social media sites. And we're putting out this thinking, putting out much more information on that depression in 2030. We are so passionate about what we do. We just want to shout it from the rooftops. So there are a number of ways to find us and find our thinking. And if we can help beyond that, please reach out to us.
Much, Lauren. It was
What?
a pleasure having you. It was great getting to sit down and kind of pick your brain a little bit. Jeff, thank you so much for joining me and bringing the hard-hitting questions.
It's always nice to let me out of my accountant box.
Yeah. And to all of our viewers and listeners at home, thank you so much for joining us on another episode of In Focus with Haversine Funding. Remember to stay informed, stay inspired, and stay on course to growing your financial platform. Until next time.